Hi, this is David of Bionic Turtle. Welcome to video 5e, which is the fifth and final video for the topic of market risk measurement and management. It published on March 15th. And that means we finished the assignments in the market risk topic, which of course is a part 2 or level 2 FRM topic. And that the final 3 readings are chapters from the Mortgagebacked Securities text by Fabose, 2nd edition. Although that 2nd edition, in our case, in terms of what's assigned to the FRM, the 2nd edition bears a strong resemblance to the 1st edition. In fact, if you have the 1st edition, it'd be okay. We have 3 chapters: overview of mortgages, chapter 1, overview of mortgage-backed securities, chapter 2, and then it skips to chapter 10 and introduces, it's a mere introduction to some of the evaluation approaches with the mortgage-backed securities. Usual, I have an associated learning spreadsheet 5E1 that demonstrates some of the Fabose concepts, and so that's tagged as medium, meaning I hope it's useful if you're looking at the spreadsheets, but not essential. Start with chapter 1 on an overview, where we're asked to itemize some of the key attributes of a mortgage, and there is some overlap here with some other sections in the FRM. Unavoidable probably, but that may indicate that it's a little more testable, some of these foundation concepts. And so we have lien status, which refers to the, which dictates the seniority of the loan. In most cases, first lien or a second lien. Most mortgage loans that are originated have first lien status, implying that the lender would have first call on the proceeds of the liquidation of the property if it were to be repossessed. And a second lien, by contrast, suggests that the creditor has access to the proceeds of liquidation only when the first lien balance is extinguished. The original loan term is obviously a feature of the loan, and traditionally most loans that have been originated are 30 years. And then keep in mind too, in regard to a 30-year mortgage loan, that our default assumption, I probably shouldn't say default, should I? Our standard assumption, unless told otherwise, is that it fully amortizes on a monthly basis. What does that mean? That means principal is getting paid off the whole way through. And then the text makes reference to the 15-year is also popular, and then including, we can avail ourselves of a 10 and 20-year original loan term. And then borrower type or credit classification. So the prime loans have been the traditional loans that focused on borrowers with the strongest credit quality. And then below those, so to speak, we have subprime and Alt-A. These definitions appear in Topic 6 Credit Risk on the securitization case study. And they're also consistently in the sense that if you're looking for a concrete definitions and distinctions here, we're not going to find them. But my summary of Fabose's, which is consistent with the Ashcraft case study, notice I put this here, that subprime tends to refer to a feature or characteristic of the borrower, while Alt-A tends to refer to the loan itself. Notice the difference there. So as Fabose says, subprime refers to borrowers with impaired credit, but they can still have sufficient equity in their homes. It's really more about the borrower. Alt-A, those borrowers, in contrast, generally do have high credit scores. So from a credit worthiness, these Alt-A borrowers are strong. But then the loan itself, in terms of documentation or some other feature, is not prime. So they may have variable incomes, or they may be unable or unwilling to document a stable income history. Credit scores are the numerical grade of the credit history of the borrower. There are different credit reporting firms. Experian uses the Fair Isaacs or FICO, which is probably the most common here in the States, and that's where, for example, that those subprime, at least up through the crisis, a subprime borrower was somebody that would include a FICO score of 660 or less. Right, so above 660 tended to include the prime, and then in our in the States as well.